Welcome to the third part of the Entrepreneur Series, kindly sponsored by Waverton Investment Management. In the episode so far, we've looked at the startup scene and raising capital, also more mature businesses seeking an exit. In today's session, we're going to talk about succession planning and life after business. To open up the conversation, I'd like to welcome Harry Cotton, Entrepreneurs Lead at Waverton.
Thank you very much, David, and welcome everyone to this third and final episode in the Entrepreneur Series, sponsored by Waverton. David, as David rightly pointed out, so far in the series, which is tracked the life cycle of an entrepreneur, we've looked at scaling up for success in episode 1. We've discussed evaluations and approaching the deal in episode 2. And now we get to look at the wealth creation event and life after the exit. So the reward after all the sacrifice and hard work. When planning this series, David, you and I have always asked what is important to that business owner and what challenges are they likely to face at each stage of their journey. And this is where the experience of working with entrepreneurs has been really useful. Every entrepreneur has their own interests and drivers, and I suppose it's our job as advisors to listen to our clients, to understand their goals, and to help build a plan to achieve them. We need to strip away some of the jargon and the complexities and to help answer the important question for them, which is what's next. And we've worked with many entrepreneurs and their families before, during, and after an exit. So we know that confronting the decision of what next is a lot easier when you draw on the experience of others. So, we really strongly believe in developing and strengthening links with advisors, investors, and other entrepreneurs, as that's often key to their success. And so far, we've been very lucky to have such an array of experience and expertise across our panels on the series, and today's no different. And so for us at Waverton, it's been a great opportunity to show the benefits of having the right investment manager at the table as part of that team around the client. I'd just like to say a big thank you to all our panelists and to everyone able to join the call today. And I'm looking forward to a really interesting discussion and plenty of Q&A at the end.
Well, many thanks, Harry. I look forward to opening up this discussion with Louise Rycroft from Timothy James and Partners. Welcome, Louise.
Hello.
So just looking at some of the financial planning aspects, perhaps you could give us a sense of how you work with entrepreneurial clients going through a process, approaching that substantial liquidity event.
Yeah, so entrepreneurs are very busy people, and they've often been so focused on building up their business, they haven't had time to think what next. But life could be very different for them. And so we help them to understand the implications of this liquidity event on their financial future. And our job is to help them explore what they can do. Ultimately, what are their dreams and how can they achieve them? Or perhaps more accurately, how can they fund them? Whether that's to be traveling the world or buying a holiday home, or perhaps giving some money away, or even starting another business. We help them understand how they can best use those exit proceeds to achieve all of this. And whilst we work with people going through the sale process, it can be quite useful for us to get involved quite early on, assuming we aren't already involved with them building their business, to make sure all of their ducks are in a row. So looking at things like making sure their pensions are in the best shape, possibly looking at their mortgage arrangements, because often there are more options before the business sale rather than afterwards. So getting involved at an early stage of the process helps make sure we've got everything covered before the deal is finalised. And sometimes there isn't much for us to do in this phase, but just to be in the background, ready to help them move on to the next phase, post-liquidity.
Okay, thanks. And just on pension planning, there are opportunities there, as you say, pre-sale that may not exist post-sale. And also in terms of, as you say, looking at how you're going to fund your retirement, the pension is an extremely valuable tool for a UK entrepreneur. Perhaps you could just explain in a bit more detail what you would look at precisely with their pension arrangements.
Yeah, so pensions are a great way of drawing capital out of the business into your personal name without paying tax. You don't pay personal tax, and the company can also save corporation tax. So it's a really valuable tool for business owners building up wealth outside of the business. But of course, when the business is sold, these contributions won't continue. And therefore, it's important to undertake some pre-exit planning to make sure that they're in the best possible shape before the business is sold. Because if they're no longer earning going forward, this could be the last opportunity. So they might want to look at making some final lump sum contributions. Taking it a bit further and looking a bit wider at pensions with business owners, sometimes company premises are held inside their pension. So we need to look at the implications of perhaps the business no longer paying rent into the pension, or possibly needing to find a new tenant. And at other times, the pension may own a stake in the business. And this big liquidity event could result in a large payment going into the pension, which suddenly means they have lifetime allowance tax charges to consider. So we look at how best to manage this, possibly by drawing some benefits now, if it should be managed at all. And those are decisions that are all unique to each individual.
Thanks. There are a lot of constraints around investing in pension, which have been ramped up recently. Perhaps you could give us a sense of the latest annual allowances. And for those with a larger liquidity event, what are the options for them in terms of tax efficient investing in the future?
Yeah, so the standard annual allowance is £40,000 or up to the maximum of your earnings. But it's usually possible for business owners to make full contributions of £40,000 as an employer contribution without any issues, although there are caps to that once your earnings get over a certain level. So it's always important to check with your accountant or financial planner that you're making the right level of contributions. And there are various ways to optimize tax aside from pensions, but I think it's important to remember that ultimately tax planning shouldn't fit around life planning. Life planning should come first, and there are various ways of making sure you don't need to pay any more tax than you need to. So after pensions, you're looking at the simple things, perhaps just like ISAs, which most people know about, making contributions of £20,000 a year. And then beyond that, if you're working with partners, perhaps looking at investing money into a non-taxpayer's name or a lower taxpayer's name, assuming, of course, both partners are comfortable with that. And then beyond that, looking at other investment opportunities like bonds can be useful sometimes, both onshore and offshore, because they allow growth to roll up gross. And they can be quite useful getting the investments working hard whilst the client's still a taxpayer. And then they can be drawn on possibly at a later date, and being able to pay a lower rate of tax on that.
Okay, and from a cash flow forecasting perspective, as you mentioned on the top, the entrepreneur's busy growing their business, they're earning well from the business, perhaps they've got high level of expenses. When they come into more of a retirement phase, they're looking more closely at the income that's derived and what they're spending. How do you help them analyze what the future position might be into retirement?
Yeah, so cash flow forecasting really helps to bring to life potential scenarios, and we find it a really powerful way of demonstrating what might happen based on various situations. For example, if I do this, when will I run out of money? Can I afford to give away some money now and enjoy watching my children or grandchildren use it? But then what if I need care fees? Can I afford it? There are so many different potential options that everyone wants to think about. So to give you a real life example, a couple recently sold their business, and they wanted to spend a lot of money on their house and also traveling the world. So they thought they had 10 years of very active retirement to fund, which could be expensive. But they also have 3 children who are still dependent. So there are school fees, university fees, and even wedding costs that they want to budget for. And these are non-negotiables. We have to make sure those are covered before anything else. So cash flow forecasting can show the benefits or not of paying school fees up front, perhaps earmarking a pot of money to fund this. And it's quite powerful to be able to demonstrate that we can ring fence this money so they don't need to worry about continuing to fund it on a regular basis, and still show them that they can afford to do all of the things that they consider a luxury when they finish working. And this is a very useful exercise for business owners, because their personal circumstances are often very different on exit than when they started the business probably many years ago. And they probably now have more responsibilities like a children or a mortgage to fund, but they still might want to take on another project or start spending some money on themselves. So cash flow forecasting can help to show that they can do all of this while still feeling secure that their non-negotiables are covered.
Okay, perfect. Well, thank you so much for that, Louise, for getting us underway in this discussion. I'd just like to bring in David Conway, tax advisor at Buzzacott in London. Welcome, David.
Hi there. Hi.
So we're focused today on sort of the post liquidity event planning, but what are some of the things that should have been done pre-exit, just to kind of recap from some of the things that have been brought up in the first 2 sessions as good and sensible planning for an entrepreneur approaching a business sale?
Yeah, well, so clearly, thank you, David. Clearly, the disposal of a business is a very key milestone in an entrepreneur's life cycle, if you like. And the best tax planning is something that exiting the business has been planned for over the course of a number of years. So it would really depend in terms of circumstances, but looking at things like, have dividends been regularly taken out during the last few years to sort of reduce the amount of cash within the company, if that's indeed what it is. But when we actually reach the point of exiting the business, the first thing to consider, I think, really is how you want to exit the business. So is this going to be a case of handing down the business to future generations? And that links in, I think, with really estate planning, which we'll talk about shortly, I think. Or are you looking at the disposal to a third party, so taking it completely out of the extended family setup? And then when you are exiting the business, what exactly are you disposing of? Are you disposing of assets, goodwill, particularly in the case of a partnership or sole trade? Or is it the straightforward sale of shares? Now, all that has a point, because really from a tax perspective, at the point of sale, the key thing you are looking at is entrepreneurs relief and whether you are going to qualify for entrepreneurs relief. Now, this is now being renamed business asset disposal relief, but essentially it means the same thing. It means that you pay capital gains tax at 10% on the first £1 million of gains when you're selling a qualifying business. Now, that's compared to 20%, which is the usual rate if you're a higher rate taxpayer of capital gains tax. Really important that when you reach that point of disposal, that you do ensure that you do qualify for what is now business asset disposal relief, if you possibly can. And there's a number of complicated rules that you need to go through. So clearly planning is important there to ensure that you do meet those rules, and it's all laid out and you have everything recorded properly to ensure that you can get that 10% rate for the first £1 million of gains.
Okay, thanks. And the inheritance tax position can change dramatically from an entrepreneur who owns shares in a business through to cash proceeds coming through. Perhaps you could explain what impact that would have on their estate tax planning and what they might do about it. What are the options for someone considering the problem perhaps for the first time?
Yes, well, certainly with regards to estate planning, I mean, what we're talking about here with estate planning is essentially how much inheritance tax does the client need to pay, or the client's estate need to pay on that person's death. And when you consider that you're talking of a rate of 40% of that client's assets, some circumstances that can really focus the mind. And when an entrepreneur is looking to exit from the business, I would say they're probably typically in their 50s or 60s necessarily, but that usually is sort of the kind of ballpark we are looking at. And that really is the right time to start focusing on passing wealth down the generations and estate planning. Particularly important if there's just been a very large sale of a business. We have what's called business property relief, where for qualifying assets, 100% of those assets is exempt from inheritance tax. Quite frequently, the interest that the entrepreneur would have had in their business would have qualified for business property relief. And if they've suddenly exchanged that, if you like, for a big cash injection, that obviously is not qualifying for inheritance tax. So there's some things there to think about. They could suddenly find that their estate is liable to a lot more inheritance tax on their death than they were in the past, possibly. I mean, in terms of options that they have, there's a number of options I think that the entrepreneurs would have. There's the obvious things, so what are called pets, which is the client gifting or the entrepreneur gifting parts of their estate to others. If they survive 7 years from doing that, then it's out of their estate completely for inheritance tax purposes on their death. Clearly, the earlier they start thinking about that, then the more chance they've got, to survive 7 years, although you never know really what's around the corner. And also potentially the use of trusts. Everyone has a nil rate band of £325,000. Certainly an estate does on the death of the entrepreneur or of the individual. But the use of trusts can be quite helpful because if you use trusts in the right way, you have a nil rate band in terms of transferring assets to that trust, and that nil rate band you get another one every 7 years as well. So there's some things to play around with there. Don't forget the use of the spouse, if there is one. Louise mentioned about transferring assets potentially to the spouse. They also have a nil rate band and what's called a residential nil rate band as well. And the rules are such now that on the death of the first spouse, any unused nil rate band, residential nil rate band, can be assigned to the second spouse. If there's unfortunately been a death of a spouse at this point in the life cycle of the entrepreneur, make sure that we would make sure as their tax advisor that we know how much of a nil rate band they're potentially entitled to from that spouse.
Okay, thanks. And we'll develop with Sue Wakefield a little bit more on the UK trust side shortly. But one thing that entrepreneurs might consider at this juncture is to look at charitable and philanthropic giving. I mean, perhaps you could explain why that might be tax efficient for them to look at while they're undertaking some succession planning.
Yes, well, I mean, there's two ways, I guess, that they can consider charitable giving. The first would be whether they want to put legacies in their will on their death. And I suppose the second one is any charitable giving that they want to make during their lifetime. So if we just sort of look at the estate, first of all legacies to charities are themselves exempt from inheritance tax. And that also includes political parties, where they don't necessarily get tax relief during lifetime for political parties. But also, if the individual wants to make substantial legacies to charities on their death, and when I say substantial, I'm talking about more than 10% of their overall estate, they potentially then could get a reduction in the inheritance tax rate of the remaining estate from 40% to 36%, which is obviously a 4% saving there. So clearly some planning needs to be undertaken if the individual is of that frame of mind. In terms of charitable giving during their lifetime, perhaps they've sold the business and they potentially have a lot more cash lying around. They want to make charitable gift, then there's obviously the gift aid system that many people are aware of. 20% credit is added to the donation to the charity that they can claim, and if the individual is a high rate taxpayer still, they get 20% tax relief there. If they want to look at something more substantial, or rather than making cash donations, they want to make gifts of land, property, shares to the charity, directly to the charity, then they can get income tax relief there via a deduction of their taxable income in the year that they make the donation. So if we have a client that wants to do those sorts of things, it's important to look at what other income they've got, so that we can plan such donations effectively from a tax perspective, both from inheritance tax and also from income tax as well.
Perfect. And how might life assurance be used in estate planning? What are the things that people might think about when setting up life assurance policies to help?
Yeah, well, life insurance, I suppose the most typical way that clients would want to use life insurance is to protect against inheritance tax liability. So, we've spoken really more about how they could reduce the exposure to inheritance tax during their lifetime. But there may be a number of reasons why, having looked at that, there's still a large inheritance tax liability. That might be, for example, if a client wants to retain control of an asset, either out of personal preference or maybe for other reasons. They might have an extensive family estate that they want to retain control of. It might not be appropriate to gift extensively to their children at this particular time, for example. So in those sorts of cases, we would often look to life insurance as a means of protecting against an inheritance tax liability on their death. And also, if the individual still has business interests, certainly extensive shareholdings, life insurance can sometimes be used for the actual company or the actual business to buy out the deceased owner's shareholding at that time. So there's a number of different ways we can look at life insurance. It's very important that the right product is taken out to ensure that it's written in trust. That ensures that the life insurance policy itself is not subject or is not included as a part of the estate on death and subject to inheritance tax. But there's plenty of people who deal in such life insurance policies, and with the right advice, both from ourselves and from colleagues that we know that deal with life insurance policies, we can ensure that that the client has the right sort of plan in there.
Okay, thanks. And just to bring Louise back in on the financial planning side, how do you see life insurance being used in succession planning? There's lots of options out there. How do people try and assess what might be useful to them?
Yes, so there are lots of options, and I suppose the simplest one is whole of life cover, which is designed to last for the individual's lifetime, but it's expensive because it's guaranteed to pay out at some point. So more often in estate planning, we tend to look at a reviewable policy where the premium is perhaps fixed for 10 years and then it's reviewed every 5 years. And that's quite a good way of getting a high level of cover at a relatively low cost. And as David mentioned, we often use that in connection when perhaps it's not appropriate at this point in time to give away significant sums of money because perhaps children are still young or the client still wants to control assets. But maybe in 10 years' time, their situation and the wider family situation will look a bit different, and they might feel more comfortable then giving some assets away. So a reviewable option is usually the most cost-effective way of sort of dealing with that short-term problem. But of course, cost depends on age and health at the point of underwriting. So it's often something that's better done sooner rather than later.
Okay, thank you for that. And just now to bring in Sue Wakefield from Zedra. Hello there, Sue.
Hi, David.
So Zedra provide trust and corporate services, but also a broader suite of services that are useful in estate planning. We chatted there about the busy entrepreneur perhaps neglecting some element of financial planning or tax, but wills and power of attorneys is another area which may get overlooked. What's your perspective on entrepreneurs having the right wills and power of attorney in place as they're kind of growing and hopefully selling their business successfully?
Well, I think you're absolutely right. I think drafting wills and putting lasting power of attorney in place is not top of anybody's list, actually, but not least the entrepreneur who's been busy, focusing all their efforts on growing their business. That said, we have seen certainly an increase in people coming forward generally in the pandemic and addressing people's minds to putting wills and lasting powers of attorney in place. So thankfully, that has also included entrepreneurs and business owners. Once it's done, though, that isn't job finished. We always recommend that if somebody has drafted a will, that they review it usually every 5 to 10 years. But certainly if there are any sort of change in family circumstances and more importantly, life-changing events such as selling a business. So that would be another time that, we would recommend that a will is reviewed. One of the other things specifically for business owners that we've been doing quite extensively at Zedra is drafting a specific lasting power of attorney for business owners that addresses the business requirements should the business owner become incapacitated. So quite a bespoke document that is really important to have in place.
Okay, thanks. And do you think that because COVID has been a health crisis above anything else, that it's actually prompted more conversation, more reflection? Have you found that people have been actually activating plans that were previously perhaps in a drawer? So it's a crisis like no other we've had.
Yeah, I think you're absolutely right. I think that the health crisis has certainly addressed minds in terms of, what if I'm hospitalized or incapacitated? Yes, absolutely right. But also they've had more time. People have had time away from the office. And even, I think, admittedly, even entrepreneurs have probably taken their foot off the pedal, some of them a little more, to enable them to put these important plans in place. Yes.
Okay, thanks. And David touched on the various decisions entrepreneurs might make, whether it's a sale of their business for cash proceeds, or perhaps passing on those shares down the generations, doing more active succession planning. This might involve bringing through next gen family members to be involved in the business. I mean, what do you see from this area? Are there any trends you can observe from the UK in terms of next gen planning? Any trends from the next gen environment?
Yeah, I think the pandemic has accelerated some of those plans, and I think we've certainly seen next gen coming through and taking an active involvement in family companies. But what we've also seen is a number of family businesses where next gen aren't involved and don't want to be involved. And I would say a growing trend that we've seen at Zedra is where the key employees therefore become the succession plan in the business. So working with entrepreneurs to put in place employee benefit trusts, employee ownership trusts, and actually, concentrating on the succession plan in that way rather than the next gen coming through. So that has been quite an interesting, I wouldn't say change, but certainly we've seen a trend there definitely over the last 2 years or so.
So the family might be divesting from the original business and then reinvesting that wealth in some other way. And I guess as trustee, you're there to help them with the governance, to support how they make decisions around that new wealth as part of the decision-making process, because it could be completely novel for that family to try and navigate. Is that right? It's a different decision process.
Yeah, you're absolutely right. And I think having an impartial trustee is often really important, especially where families are taking different paths. Yeah, we're often brought in to support with, a very wide range of family views, differing opinions. That the impartiality of a professional such as Zedra is very crucial.
Okay, and we heard from David, some of the limitations around UK domiciled person using trusts in terms of the allowances that are there. It can be easier transferring in UK private company shares. I mean, what do you see in terms of, you've got a substantial onshore trust business, so what do you see from that? Is very common for people to use trusts in the UK to own shares until a liquidity event is reached?
Yeah, I think certainly the inheritance tax regime in the UK prevents substantial funds going into trust and in a sort of ring-fenced trust environment. But business property relief is one area that is still very, very commonly used to create trust structures, enabling clients to move substantial funds into that ring-fenced environment. I think from an exit perspective, it's really important at that point to, as a professional trustee, to understand the reason for the trust to be created. What are the next plans now for the family? Obviously, the immediate important trustee decision is, how do you reinvest those funds? Significant funds now coming into the trust, and it's an opportunity for families to then perhaps de-risk a little, move away from the business environment into more of a mainstream non-BPR portfolio, or to retain that BPR and actually buy replacement BPR to continue the IHT-free environment that the trust is in. But I suppose underlying all of that is understanding, what is the trust there for? It's often there for multi-generational planning. It's almost a family lifeboat, I suppose, to the family that has been put away. So yeah, discussions, talking, making sure that we really understand what the next 10, 20, 30 years looks like for the family.
And how might the management of those assets change when you go into beyond the liquidity event? There's a lot of copy written about ESG and sustainability in portfolio management. Now we're going to talk with Alexandra on investment trends shortly, but what are you seeing as a trustee? Are you seeing those demands from clients on to invest in a certain way with sustainability in mind filtering through, or are we still some way off from that becoming a real part of the everyday?
I think that's a great question. For entrepreneurs, I would say absolutely ESG is top of the list, and we're increasingly seeing those conversations. Mainstream trustee, perhaps not so much, but I think certainly for the entrepreneur, yes. And I'm sure Alexandra will be talking in great detail, but I think the fact that there are so many great opportunities to invest sustainably brings that trustee role more important, actually, to make sure that we're comfortable with the way the trust funds are invested.
Okay, and on the charitable side, we heard from David, there's lots of tax efficiency to charitable donations. How might that look in a trust context?
So the other thing that's been interesting through the pandemic, actually, has been the increase in clients wanting to set up charitable trusts or charitable foundations, which has been really pleasing. I think, again, there's perhaps been that time element. And generally, the UK has focused more on charity. So actually putting their large charitable donations into a formalised structure, a tax-efficient structure, as David has already described, is something that has been really on the increase. As David said, charitable trusts can be set up with cash or with other assets, and the philanthropic and gifting strategy of the family is defined in the trust deed. More importantly is probably the letter of wishes that sits alongside that. So family can really sit down and define their gifting strategy, but they don't have to have that as rigid and set in stone. We work with them on an annual basis more frequently to update the letter of wishes and give them the opportunity to change that gifting strategy if they want to. But yeah, from a tax efficiency perspective, it's arguably that the best kind of trust that you can set up. Great for entrepreneurs whilst they're still paying tax, obviously from a gift aid perspective. But the charitable trust itself also has an ongoing tax-free environment. I think for families that are really wanting to make a difference and actually set up a lifelong and post-life, I suppose, legacy, then a charitable trust or foundation is perfect. I suppose the last thing to say in terms of exiting entrepreneurs, it is from my experience, it gives them that opportunity to still really make a difference. Maybe not in their, obviously not in their existing business, but actually take this on as a new endeavour.
Okay, well, many thanks for that, Sue. Very, very helpful. I'd like to bring in now Alexandra Buchan-Heelas from Waverton. Welcome, Alexandra.
Thank you very much, David.
So we've heard a recurring theme is the busy entrepreneur, little time to consider many aspects of their financial life that they may never have managed or needed to create an investment portfolio for liquidity. Perhaps you could explain how you'd work with an entrepreneur in order to try and navigate the new world that they find themselves in, needing to construct an investment portfolio with wealth created through a business sale.
Absolutely. So what's really important from us right from the outset is working really closely with advisors like accountants, financial planners and trustees to really understand what the purpose is for this individual portfolio that we've been entrusted with. And once we've figured out exactly what the portfolio is for, then we're in a really good position to construct a portfolio around that client. The first step in that process is often the time horizon. Are these shorter term assets that might be required for another business investment in the short term, in a few years? Are these assets for the children, the grandchildren, for school fees, for buying houses? Are these charitable assets that are being run in a charitable trust? And it's really figuring out the nub of what the underlying client needs these assets for in the future that helps us to build a portfolio around exactly what they need. And the main way of doing that is working really, really closely with advisors. I think one thing that we find with entrepreneurial clients is it's a big change in control for them, where they're used to running their own business, making a lot of decisions, knowing everything that's going on, to move from that to a discretionary portfolio management situation where they're obviously getting a lot of reporting and communication with us, but they are essentially handing over to control to someone else. That can be quite a leap. So as with everything in the private client industry, trust is absolutely essential and really important. I think one of the best ways to build up that trust is to be working with a team of advisors around a client who they know, get to like and understand how we do things. So that's really the starting point for us.
And on that time horizon point, if the entrepreneur is setting a portfolio for children or next generations to benefit from, is it that you would then weight much more towards equities because in the long run equities outperform? I mean, what's the next step on from the entrepreneur that says, actually, we've got a huge time horizon, we've got a lot of the short-term liquidity needs met. Where do you kind of go from there with the client looking to invest over a long time horizon?
Yeah, the highest level of risk, if a client has a willingness and the knowledge and understanding to invest in all equities, then we're very happy to create an entirely equity-based portfolio. Often we don't go straight to that. We end up with a sort of balanced or a growth portfolio that's in sort of 60 or 75% in equities, that's aiming to achieve an inflation plus, say, 4% over a long period of time. And that tends to be somewhere that people are comfortable investing at the outset. Particularly if there are trustees involved that are taking a fiduciary responsibility, they're probably not going to jump straight into a full all equity 100% invested portfolio. So yeah, we start with time horizon, we then look through volatility and risk, and then talk about return expectations. So it's really a step-by-step process, working hand in hand with the other advisors. One thing I would say that's quite interesting, I talked a bit about the change in control that entrepreneurs go through when they move from running their own business to handing over management of assets to a discretionary investment manager. They're sort of changing gear. And when you think about the risk return characteristics of the business, that's also a real change in gear for them. Often these really successful companies, they maybe have achieving double-digit levels of growth, generally with a quite high level of volatility, and particularly the outset, a real risk of permanent capital loss. And shifting into a discretionary managed portfolio like one at Waverton, the returns are not going to be as stellar and exciting as they may have achieved in their own business. But equally, they're not going to be taking the same level of volatility and not the same level of risk of permanent capital loss. So it's really a process of finding a happy medium where they're comfortable, we're comfortable, and the advisors are comfortable, that we're all sort of on the same page, because it can be quite a major shift for them from full control, high risk, high return to less obvious control and more sort of muted and controlled levels of risk and return.
Thank you. And have you seen increased demand in ESG and sustainable portfolios, building on what we were saying with Sue around next gen and changing tastes and preferences?
Yeah, definitely. People have become much more aware of it, it's been a really interesting evolving trend. We, Waverton, probably haven't been as good as sort of shouting loudly about what we do on this front as we should have been and could have been over the last few years. If you look at our key investment criteria when we choose stocks, and most of our portfolios are constructed using direct stocks that our analysts look at and select individually. Likewise, our bonds and alternatives are selected internally by our teams. When you look at the kind of investment criteria that we are looking for, it plays really neatly into ESG criteria, specifically the social and governance side of things. We look for companies with a sustainable competitive advantage that we think are going to be able to continue to do what they're doing now for a long period of time. We look for companies where their interests, the board, the management, the way that remuneration works and the governance are all really well aligned with the shareholder. And that fits really neatly with what people are looking for with ESG. The only thing that we don't explicitly do, although we can if a specific client requires it, is impose any specific ethical restrictions on portfolios. We don't exclude any sectors or things like that, because ultimately we don't think it's our job as investment managers to impose our own ethical views on a portfolio. That's for sort of clients to ask us to do. But ESG factors are really well embedded in the way that we pick stocks, and we've been having a lot more discussions with clients about that, which has been interesting and really enlightening, actually. And I think it's a trend that will definitely continue. And the next generation, but equally older generations and existing clients are really, really interested to hear about how we look at things and how we invest in that way.
Okay, great. And how might you take into consideration an entrepreneur with business interest in, for example, technology or property, or how do you go about constructing that picture, given there might be constraints because they don't want to be overweight, doubled up on risk in certain sectors?
Yeah, definitely. It's really important. And I think that initial phase of getting to understand their requirements and their existing exposures is really important from that perspective. Our whole ethos with constructing portfolios is that no two clients are the same, therefore no two portfolios will necessarily be exactly the same. So we really start from the client and build the portfolio around that using the wealth of knowledge on our investment team. And by constructing portfolios with direct stocks, we actually have a high degree of control over excluding specific sectors or geographies or any area where they have a huge amount of exposure already, any area they want to avoid, equally any area that they're particularly interested in that they want more exposure to. So we work hand in hand with clients and with advisors to take a sort of holistic overall view. And as I say, by having that direct approach, we have a really strong grasp on factors, sectors and geographies, so we can nuance portfolios to take all requirements into account.
Okay, thanks. And how do you help children or entrepreneurs who are coming through in a position where they're likely to inherit substantial wealth? They need to understand how they're going to invest that money with the support of professionals. What do you do in that space to help educate those who are likely to receive these proceeds?
Yeah, it's a really enjoyable and interesting part of the job, actually. I really enjoy doing and speaking to younger members of the family and helping them to understand how things work, whether that's sort of informally in client meetings or on calls, speaking to them, explaining the building blocks of portfolios, how we do portfolio construction and what our investment thesis is here at Waverton, all the way up to more formal 1 week work experience that we do internally largely with clients. Where they come into the office, they meet our CEO, our full investment team, our CIO. They undertake a project looking at a couple of stocks, which they present to a panel, sort of a Dragon's Den type environment, although hopefully slightly less scary and not publicly televised, which is a relief. And we also do some more careers orientated things like looking at CVs and giving them practice interviews and things like that. You know, they might not genuinely be interested in working in the investment realm. So we try to provide them with a broad level of knowledge from everything that our whole team at Waverton can provide. And that's something that I think people really appreciate and really enjoy. And I think that entrepreneurial clients in particular really want their children to have a high degree of education and understanding. Because as you say, they may be coming into a huge amount of wealth from maybe much less wealth. You know, it's a major change in their life circumstances. So understanding it, being educated, knowing what questions to ask, being able to, speak lucidly with investment managers and other advisors is a real benefit and something we think is hugely important, and hopefully we facilitate at Waverton.
Okay, terrific. Well, just as we bring this panel to a close, before we open up for questions, I'm just going to come to each of our panelists just for that one top tip that they've got. What's the one thing that they think entrepreneurs should take away and consider in their personal financial planning or personal circumstances? Perhaps Louise, you could open us up with what's the key tip there that you would want entrepreneurs to take away from this session?
I would say have a chat to an advisor, tax planner, accountant as early as possible, because the sooner we get involved, the more value that we can add. And a chat, it costs nothing, but you can go away with a tip or two, and maybe you don't need any help for a few years, but you might get a good starting point.
Great. So start your planning early. David, from the tax side, what are the things? What are the one thing that you would say, or what are the top tips that you've got for people to?
Well, I mean, I think really I can only really agree with Louise in terms of planning is the most important thing. Certainly from an inheritance tax perspective, it is very important. The last thing you want to be doing is to be planning for inheritance tax when something has happened. That's definitely the last thing that you need. So yes, certainly do start thinking about inheritance tax. It's not really a topic that many people like to think about too much, but it is an important topic. And with that planning, with that chat with a tax advisor, things can be put in place, and then things will be a lot more straightforward going forward.
Thank you. Sue, any top tips, takeaways for people, things that they should really look at?
Mine's probably really simple, actually, David, and that's make sure you have a will in place, even if it's just a simple will. Intestacy can be very, very difficult for families, both expensive and time consuming. So yes, take some time out and put a will in place.
A useful tip. Alexandra, any top tips that you've got for entrepreneurs?
From my perspective, I would say changing from investing in your own company to investing in public markets is definitely a change of gear. but find an investment manager that you trust, that you understand what they do, and that is able to meet all the requirements that you and your family have.
Harry Cotton, just before we open up for questions, we've worked together on these three discussions, which have been really interesting and taken us through all the different elements. What are your thoughts as we close this panel and open up for questions?
Firstly, I'd just like to say a big thank you to all our panelists, to Louise, Sue, Alexandra and David, but also David, to you and your team at PCD for hosting us. Well, we've really enjoyed filming this series, and although we couldn't possibly cover all of the issues facing our entrepreneurial clients, I think you'd certainly agree we've signposted more than a few. And there's also been a few common themes that have run throughout each episode. Communication being one, but really the importance of having the right team of advisors around you and engaging with them early seems to be almost the top point from most people. So yeah, just a big thank you, David. And if you'd like any more information from us at Waverton, then please do get in touch.
Terrific. Well, and on that note, we'll open the floor for questions.